Walmart stock is splitting 3-for-1. We're going to go through Walmart stock, and we're also going to analyze it through our stock analyzer tool to determine the right price to pay for Walmart stock after the split. But first, let's understand what a stock split is, because a lot of people have a misconception of stock splits. A stock split doesn't change anything about the company. All it changes is this right here and the number of shares outstanding. That's it. The stock doesn't become cheaper. You might sit there and say, well, Paul, if it's a 3-for-1 split and the stock's at 180, it's going to go to $60. It is cheaper. Okay. The price for the share is cheaper. But let me go one step further. In our income statement on our software, if you scroll all the way to the bottom here, it'll show you basic shares outstanding and diluted shares outstanding. This number shows 2.7 billion. With a 3-for-1 split, it's going to triple. It's going to go to 8.1 billion shares outstanding. So all you're doing now is you're taking all the revenue and profit all the way up here and splitting it amongst more shares. Okay? What that does is, for example, the great analogy I heard the other day is, if you have a pizza with 8 slices on it and you cut every slice in half, you've doubled the number of slices, but the pizza stays the same size. That's all that's happening with a stock split. Guess what's going to happen here with the market cap? Well, currently the market cap of Walmart is $487 billion. How do you calculate that? The 2.7 billion shares outstanding multiplied by $180 per share. Just to show that to you, let's pull up a calculator. We have 2.7 billion shares times 180, $486 billion market cap. Okay, now, what happens when you triple the number of shares and cut the price by a third? Well, like I said, we're going to have 8.1 billion shares outstanding multiplied by $60. Well, look at this, the exact same market cap. That will not change. We have to stop looking at a stock split as making the stock cheaper. So why do companies split their stock then? Well, because they understand the market perceives a lowered price as a cheaper company. They think it drives up demand for the company, and temporarily it very well could. Some major companies in the last few years have split their stock. Google, Apple, Tesla, all these major companies do it because they want to make their price from $3,000 down to $150 to make it more attractive, because people feel warm and fuzzy inside when they buy more shares of a company. But guys, the great news is you're watching this show and you're part of our channel and you've subscribed to our channel and you might be a subscriber to our software and you know better. You understand this is just a marketing ploy. When this stock goes to 60, it's purely marketing. You're still going to have access to the same amount of the company, because what happens is if you own 1,000 shares of the company or 100 or 1 share of the company, all they're giving you is 2 more to triple your number of shares. That's all they're doing. So now you're going to have 3,000 shares or 3 shares. That's all they're doing. That's all they're doing. Now, if you look at a company like Berkshire Hathaway stock just hit $600,000 per share. They've never split it. Back in the day, it was $7 to $10 a share back when they first bought Berkshire, which was a textile manufacturer in Maine. But the reason they haven't done that is they want people to buy the stock who are ingrained in the business and want to own it. Because in order to own a $600,000 stock, they need to sit there. The person has to have a very long-term approach to dedicate that much capital to the company. Now, they've also created Class B shares, which makes it much more affordable. For people who dabble into options, remember, 1 contract in an option is 100 shares. They don't care what the price is. So before, 1 contract was trading basically $18,000 worth of stock in Walmart, 180 times 100. When it goes to $60 a share, it's now going to be $6,000. Makes it much more affordable for the options market. So let's go analyze Walmart now as a company like we normally would, because again, the only thing changing is the number of shares outstanding, which will affect the price of the stock. But overall, market cap will still stay equivalent to around $486 billion. The enterprise value will be $650. This difference here, guys, is debt. Now, that debt doesn't worry me because Walmart has a lot of locations. They pay a lot of leases. That is a part of their debt. So I'm okay with that. They're still dominant in this space. Now, Now, last year, they made $12 billion in free cash flow, which is a lot lower than their 5-year average of $15 billion. So I'd want to understand why that free cash flow is lower. The net income last year, pretty much on par with the free cash flow last year, $11.7 billion. But their 5-year average net income is actually lower than their 5-year free cash flow. I like that more than the other way around, as you know if you've watched our channel. Now, guys, this PE is going to stay the same, no matter what the stock split. Again, the PE will stay the same because now you're splitting the profit amongst way more shares, okay? And the price to earnings ratio is based on the price per share divided by the earnings per share. Guys, the one thing about Walmart is their profit margin's very low. Last year, their bottom line profit margin after paying all overhead, all taxes, all interest, everything was 1.9%, which is lower than their 5-year average of 2.3%. This gross margin here of 24% means every extra dollar they sell, 24 cents of that goes to profit before paying overhead and things like that, okay? That's pretty consistent with their long-term 25% average, more or less, all right? Let's go see what the 8 pillars look like. All right, so this is Walmart's 8 pillars. Guys, we've got a high PE, a high price to free cash flow. We've got some buyback of shares. Cash flow is actually down $1.2 billion, even with net income up 1.9. So I think before you invest in this company, understand why the free cash flow and the net income differences over the last 5 years. They're probably a very, very logical explanation, especially for a company as large as Walmart. So now, what are analysts saying about Walmart? Now remember, I'm very skeptical of analysts. They have just as many, if not more, biases than you do and I do because they have to kind of be with everybody in the market, right? But look at this growth in EPS from $6.52 a share to $8.95 a share. Pretty solid growth for a company like Walmart, okay? The company's so large to be able to grow mid to high single digits earnings per share. And for revenue, also impressive. $648 billion to $737 billion. It's kind of some growth. Now, the reason Walmart's up is they reported income and revenue and beat expectations, which is great for a company as large as they are. So the question is, can you overpay for a good thing? And of course you can. So that's why we have Stock Analyzer tool. Now, before I get into this, guys, I'm very passionate about our software. I use it every single day. I engage in the community every single day. There's over 16,000 people have signed up for the software, and there's so many tools and benefits to all of it that we haven't even covered here. Let me show you. Right here is our recap of our tools, right? We have a mobile app, everything on your mobile phone. You get the 8 pillars. You get 30 years of financial data. You get the Stock Analyzer tool. You get exclusive content for just members of our community. You get access to Mo and I. You have the real estate calculator, stock screeners, retirement calculator, which I still use every single month, and EM community with like-minded investors. Guys, being a value investor can be a lonely road. That's why we created the community of thousands of people who talk every single day about it. We have a special running right now, $7 for 7 days. Try out the software, dip your toe in, see how you like it. But clearly, it provides way more value than other people out there. So everythingmoney.com, $7 for 7 days. Go try it now. And we're going to use our most popular tool here, which is a Stock Analyzer tool. Now, I'm going to pull up Walmart and our history of Stock Analyzer. I'm going to look at our assumptions we made. There's a few things I've changed over the years and how we make our assumptions, okay? So, for revenue growth, I did 2.5%, 3.5%, and 4.5%. I'm comfortable with that. I look at it saying Walmart will likely grow just a little bit better than inflation as they open more and more locations around the world. So I'm fine sticking at this 2.5%, 3.5%, and 4.5% revenue growth, okay? Profit margin. I did 1.75, 2.25, and 2.75. I just think that's a little low. I think I'm going to go with 2, 2.5, and 3. I think, am I being too aggressive here? I don't know. Now, for free cash flow, their free cash flow in the last 5 and 10 years has been higher than their profit margin. So I did go a little bit higher. I went 2.5, 3, 3.5 for free cash flow margin. Now, what is the right PE and price to free cash flow to pay at the end of 10 years? Well, the market's about 15 times over long periods of time. That seems about right for Walmart, but I do think it's a moat. So I actually put 15 on my low side. I put 15, 18, and 21. A company like Walmart, I believe, deserves a premium. Now, the final thing I did was, what's my desired return? Now, the desired return is essentially where you put in your margin of safety. The market does 9 to 10%. And I put in here 10, 12, and 14 here. As I made higher assumptions, I wanted a higher desired return. But I've been changing it lately to just show me, Paul, what do you think the company's worth based on the 9% return in all your categories? And from there, you and I can adjust our margin of safety. So I hit the Analyze button. The stock's currently at 178. I have a low price of 70 to 90, a high price of 150 to 175, and a middle price of 105 to 125. Guys, clearly it's overpriced, which is pretty consistent with this high PE and price to free cash flow. So I just got to be patient to wait for the right price for myself. So guys, go to everythingmoney.com and try out our $7 for 7-day trial on our software.